Is Bitcoin and crypto about to peak before a major market crash and year-long bear market? Everyone right now thinks the 4-year Bitcoin cycle is broken. That the 4-year pattern that's defined every major bull and bear phase since 2013 is dead. But according to hedge fund veteran Mark Yusko, that belief couldn't be further from the truth. Yusko argues that Bitcoin's rhythm is still perfectly intact and that the people calling this time different are setting themselves up for another massive surprise. If Mark is right, we should still expect Bitcoin and crypto to peak in either November or December of this year before a brutal crash and bear market in 2026. Here's where Mark thinks everyone has gone wrong. In his latest interview, he explains that Bitcoin is innovation itself, the fifth great asset class alongside stocks, bonds, currencies, and commodities. Just like the internet in the 1990s or mobile in the 2010s, blockchain is the next technological wave. And every cycle of innovation follows the same pattern: disbelief, mania, collapse, and rebirth. In this video, we're breaking down Mark Yusko's bold claim that everyone is wrong about Bitcoin's cycle. We'll cover why he still believes in the halving-driven rhythm of 4 years, how fair value models point toward 100K and beyond, and why dollar devaluation and steady accumulation may quietly be fueling the next phase of Bitcoin's bull market. Stick around to the end because Yusko's latest insights could completely change how you play the rest of 2025. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's break down exactly why Mark Yusko believes the 4-year cycle is still driving Bitcoin's price, and how this setup could lead to one of the most explosive bull runs the market has ever witnessed.
It's stocks, bonds, currencies, commodities, but there is a fifth thing, which I will argue is innovation. So innovation as an asset class, like creating new things, whether it was the internet in 96, whether it was the mobile net in 2010, whether it's the truth net today, blockchain technology. So all of that, and Bitcoin is one of those things, right? It is a reinvention of money, right? The famous JP Morgan quote, gold is money, everything else is just credit. That's true. But Bitcoin is better gold, so it's better money, and everything else is still just credit. And so that's an intro to say, well, what about this carnage and the cycle? And look, I'm in the maybe not so vocal minority that believe that the 4-year cycle still exists, and that there will be another crypto winner, and it's possible. I'm not saying probable, but it is possible. And I don't want this to be the case, but it is possible that we've already entered into the new crypto winter.
Innovation is now a market of its own. The early internet created it, mobile networks expanded it, and blockchain is redefining it. Bitcoin stands at the center of that shift. It is not a product or company, but a new form of value built for a digital economy. Gold once served as the world's foundation for trust, but Bitcoin improves on its design by being transparent, scarce, and accessible without borders. Its worth is enforced by code, not government, and its supply cannot be altered by policy decisions or inflation. Price volatility hides what is actually happening underneath: steady adoption, improving liquidity, and deeper integration into global markets. Institutions are building around it, developing ETF products and custodial systems to meet growing demand. Bitcoin has moved from an experiment to an essential part of financial architecture. Each correction has removed speculative layers, leaving stronger holders who understand its role as digital property. This is not a finished market. It is still early in its life, where volatility is the cost of discovery. As currencies weaken and capital seeks harder assets, Bitcoin's advantage becomes clearer. It represents a system that functions without middlemen, where ownership cannot be diluted or censored. Mark Yusko frames Bitcoin within the larger story of innovation shaping wealth. In his view, this cycle of creative destruction follows the same pattern that built past technological revolutions. The belief that Bitcoin's growth has peaked misunderstands the nature of innovation itself. It compounds quietly until it suddenly redefines everything. Next up, we focus on how investors should handle the present phase of the market, particularly through the rest of the year.
Look, I want to believe that there's more demand and organic demand than supply, and that we're still on track for higher highs in Q4. I am concerned that the ripping out of the leverage that occurred on Friday and the destruction of that retail cohort may make that pretty impossible. Now, that's the bad news. The good news will be, since we didn't go to 170, we don't have to fall to 65. So we could now just chop around this level, and money devaluation, dollar devaluation is going to continue at about 6 or 7%. And so we should just steadily accrete.
In 2024, the most recent halving again cut issuance in half, setting the stage for reduced new supply heading into 2025.
6 months from now.
The current market may look uncertain, but that's exactly where opportunity forms. The leverage wipeouts that rattled traders in recent weeks didn't destroy the trend, they reset it. When leverage collapses, it clears out speculation and leaves room for organic demand to rebuild. That's what's happening now. Despite short-term fear, underlying demand remains strong and dollar devaluation continues to erode the purchasing power of cash. When a currency weakens at 6 or 7% a year, saving in it becomes a losing game. Holding Bitcoin through these periods or steadily buying through a strategy like dollar cost averaging has historically outperformed every attempt to time the market. Short-term traders often misread consolidation as weakness, but the data tells another story. On-chain activity shows that long-term holders are accumulating and institutional demand through ETF products remains steady. The number of addresses holding one full Bitcoin has reached all-time highs, and miners are still securing the network at record strength. When liquidity returns, often in the months following a heavy correction, these structural factors tend to push prices upward faster than most expect. Each correction has a purpose. It removes the noise and strengthens the base for the next leg up. Traders who panic out of positions often return later at higher prices, while disciplined investors who accumulate during quiet periods end up capturing the largest gains. Mark Yusko views this phase as a time for accumulation, not panic. As inflation remains above target and monetary policy slowly turns dovish, the environment favors assets with real scarcity. In his outlook, the next major move forms quietly, while most investors are still uncertain. Next up, we look at why the 4-year cycle remains the backbone of Bitcoin's market structure and how it continues to dictate each phase of expansion. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
And look, there's a 4-year cycle for a reason. Well, what is that reason? Well, it's tied to the halving. Well, why? Well, let's just think about it. What is the Bitcoin network, right? It's a network of computers around the world that donate their compute power in exchange for block rewards. Now, they can also get transaction fees, another story for another day, but the bulk of how they're compensated is block rewards. And, Nakamoto built in to this, the bulk of how they're compensated is block rewards. And Nakamoto built in to this code that the block rewards would get cut in half. Now, let's just think about that for a second. If you're operating miners, your costs are kind of fixed. Your electricity costs are fixed. Your rent for the space is fixed. You've already bought the miners and you got a depreciation charge against that. So if the number of block rewards gets cut in half, if the price stays the same, half, arguably, of the miners need to go out of business, unless the price adjusts, which is exactly what we've seen in 2009 and again in 2013, and again in 2017, and again I'm sorry, not in 2009, 2013. Sorry, it was founded in 2009, but in 2013, 17, and 21, those three cycles, we had a movement of the price to increase so that the block rewards total would match. Well, what that does is it brings in activity, right?
Every few years, the same rhythm returns to Bitcoin, a rapid rise, a brutal correction, and then a long climb to new highs. This pattern isn't random. It's coded into the system through the halving event, where the number of new Bitcoin created every block is cut in half. Each halving reduces the supply flow, forcing the market to adjust as miners need higher prices to remain profitable. Their costs stay fixed, but their rewards fall. When that happens, weaker miners shut down and surviving ones hold their coins, tightening available supply. The result is a price adjustment that restores balance, which has repeated every cycle since the beginning. After each halving, the same dynamic plays out. Supply shrinks, demand returns, and the network becomes more efficient. Analysts tracking miner profitability and hash rate can often see the cycle forming months in advance. These technical foundations explain why the 4-year pattern has stayed intact through every bull and bear market since 2013. It's not psychology, it's economics. The halvings are predictable and markets eventually price in scarcity. Combined with growing institutional participation through ETF products and global payment integrations, Bitcoin is entering a stage where demand growth outpaces supply. The structure is the same, but the scale is far greater than before. Mark Yusko views this mechanism as the key to understanding Bitcoin's long-term trajectory. The halving isn't a superstition, it's a mathematical schedule that shapes the flow of capital into the network. With every cycle, volatility declines, liquidity deepens, and long-term value compounds. Next up, we explore how previous cycles reveal where Bitcoin stands today and why fair value models point toward triple-digit prices ahead.
Long story short, 2017 into 18, right? We have this peak at 20,000 and then go into a bear market, okay? Then we come back in 21. In 21, fair value was 30,000. Now remember, when Luna hits Terra, things start to get a little bit ugly. But then the FTX thing happens in November. In November, we were all the way to 69K. Fair value is like 32K. We're 2 times fair value, just like in 2017, we're 2 times fair value. Well, when you're 2 times fair value, what has to happen? You have to go back to fair value. Now, what's the trigger? Deleveraging. And the problem is in both 17 and 21, the leverage was super high. And so we went bam, down 84%, 74%. We went through fair value, we got to cheap, and then the investors come back at 15K this cycle. The investors, like us and others, come back, and then we start moving back to fair value. Today, fair value is like 105, 110, Metcalfe's law. So here we are, toward the end of the cycle. I would have said, and I actually did say in January, that I thought there wasn't as much leverage this time as the last 2 times. So we were only going to go to 150 to 170, about 50% premium to fair value, which meant we'd have a lower drop.
Every cycle has its extremes. In 2017, Bitcoin reached $20,000 before plunging into a long bear market. In 2021, it hit $69,000, driven by massive leverage and overconfidence. Both times, the asset traded roughly twice above its fair value before collapsing back to equilibrium. When the system becomes overly leveraged, forced selling drives the price below its true worth. That's exactly what happened when the market fell to $15,000 in late 2022, a level that attracted long-term investors back into the market. Today, the story is different. The estimated fair value of Bitcoin is around $105,000 to $110,000. This estimate is derived from network activity, liquidity depth, and adoption curves, all measurable fundamentals that have expanded since the last cycle. While the market may fluctuate, these metrics provide a compass for where price tends to settle once volatility passes. It's the same process seen in every technological asset as it matures. Valuation overshoots, collapses, then stabilizes at a higher baseline. Unlike in past cycles, leverage appears less extreme. Large holders have reduced risk exposure and much of the speculative excess has already been flushed out. That's why the next major correction could be shallower than before. With more institutions holding Bitcoin as long-term reserves and fewer exchanges allowing unchecked margin trading, the base is stronger. Mark Yusko views this equilibrium as a setup for the next expansion phase rather than a peak. He emphasizes that fair value is not a ceiling but a midpoint between emotions of fear and greed. As long as capital continues to move from weaker currencies into assets with limited supply, the fair value line will keep trending upward. Next up, we focus on market psychology. Why the belief that this cycle is different may be the biggest mistake investors are making right now.
Everyone, and I mean everyone, was saying, hey, all we can do is get through, Rectember and October will be great. Well, when everybody believes something, it usually doesn't happen. And it can be exploited by whales, which is what we saw, this whale that went short on Friday. 1 minute before the announcement. I'm just be a betting person that there was some correlation of knowledge there, but whatever. So, but my point there is that Pomp's right. If everyone's projecting a crash, it probably isn't going to happen, but that's not what everybody's projecting. Everyone, and I do mean everyone, has jumped on this bandwagon of, oh, it's different this time. The 4-year cycle's over. We've institutionalized. There's too much demand, not enough supply. And it's true. We don't have enough supply of what's mined every day. Mm-hmm. But there's plenty of supply. There's plenty of people with basically no cost basis.
When too many people agree on the same outcome, markets move in the opposite direction. This is one of the oldest patterns in finance, and it's unfolding again. Throughout recent months, the dominant narrative has been that Bitcoin's 4-year cycle is finished, that institutionalization has changed everything, and that volatility is gone for good. Yet this mindset often marks the point where complacency sets in. The assumption that it's different this time has always preceded sharp reversals. When traders become convinced that prices can only go up, large players take the other side of the trade. The recent example was the sudden short position opened by a whale just before a major announcement. It exploited the predictable optimism that flooded the market. These moments show that even in a maturing market, human behavior hasn't changed. Bitcoin's structure may evolve, but greed and fear still dictate short-term moves. What separates the long-term winners from the rest is patience. Those who understand that halvings, liquidity cycles, and value discovery continue to repeat in a familiar rhythm. The crowd's obsession with quick profits misses the broader picture. There is still abundant supply in dormant wallets, and each surge in confidence draws some of it back into circulation. Yet that same supply shrinks over time as holders grow stronger and new issuance declines. That's the silent force still driving the cycle. Mark Yusko sees the disbelief in this repetition as the market's blind spot. He maintains that the structure born from Bitcoin's design hasn't vanished. It's only adapting to larger players and deeper liquidity. The narrative of the 4-year cycle being over reflects emotion, not reality. And as the next expansion forms quietly under the surface, those ignoring the pattern may once again realize they were early in doubt but late in conviction. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.